Welcome to today's Explainer. Look, if you're tuning in, you're probably trying to cut through all the noise out there, avoid making some truly expensive mistakes, and just tune out the loud financial influencer hype. Well, today, we are stepping into the role of the calm, rational investor. We're going to master a fundamental superpower that, honestly, most beginners completely overlook, and that is basic due diligence for ETFs. By the time we wrap this up, you're going to have a highly structured, step-by-step system to choose funds with absolute confidence.
Here is our incredibly simple roadmap for today. We'll start with the shiny ETF trap, then go through the 5 ETF checks, compare safe versus risky funds, establish your ETF quality role, and finally wrap up with a 7-day checklist. All right, Section 1, the shiny ETF trap. Beware the marketing. Okay, let's dive into this with a quick cautionary tale about a guy named Dylan to figure out exactly what not to do.
So, Dylan didn't want to gamble on meme stocks, right? He really wanted to invest responsibly. He ends up finding this ETF with a beautiful futuristic theme. You know the type: artificial intelligence, green energy, the future of global innovation. The marketing was spectacular, but the reality was a total crash waiting to happen. Because Dylan trusted that polished branding over actual structural reliability, he ended up getting hit with incredibly high fees, a really wide trading spread, and just terrible diversification. When the market took a little dip, his fund literally plummeted. He essentially went to the dealership and accidentally bought a customized, highly volatile sports car when all he really needed was a reliable, everyday commuter vehicle.
And this brings us to an absolutely crucial mind shift. You might be sitting there thinking, well, I don't really know how to analyze complex financial products. But think of due diligence exactly like reading the nutrition label on your food. You absolutely do not need to be an expert dietitian with a PhD to eat healthy, right? You just need to know how to spot the hidden 90 grams of sugar in a box that's heavily marketed as healthy. We're simply looking for the obvious red flags.
Moving on to Section 2, the 5 ETF checks, your beginner system. This is where we build out your foolproof filter to weed out those bad bets.
Now, what's really interesting about these 5 steps is that they are basically the financial equivalent of confirming an airplane actually has wings before you decide to board it. I mean, it's not glamorous. You're for sure not going to feel like a Wall Street insider doing this, but it will keep you incredibly safe. Let's walk through these 5 due diligence checks that you can easily apply to literally any ETF in under 10 minutes.
Check number 1. And honestly, this is the most critical. What does the ETF actually track? Think back to Dylan. He bought a theme, not a foundation. Complex, hyper-specific specialty themes like lithium miners or cloud computing innovators are just not the foundation of a solid beginner portfolio. Broad market exposure is what you're after. The golden rule here is so simple. If you cannot explain exactly what the ETF tracks in one simple sentence, do not buy it.
Check number 2 is all about the expense ratio, or your annual fee. Now, an expense ratio of just 0.50% might sound incredibly tiny, but in the investing world, this is a silent wealth leak. Fees compound negatively. To put a surprising number on it for perspective, if you invest just a few $100s a month over 30 years, paying a 1% fee instead of a fraction of a percent can secretly rob you of nearly a third of your total potential wealth. A third! You want this number to be as low as humanly possible for your foundational funds.
On to check number 3. Assets under management, or AUM. This is literally just the total amount of money parked in the ETF. And why do we care? Because size equals stability. A massive AUM signals deep institutional support and widespread popularity. You have to be incredibly cautious here. If you buy a tiny niche ETF, there is a very real risk that the fund could just close down on you due to a lack of interest. And let me tell you, that creates a massive administrative and tax headache you do not want to deal with.
Moving to check number 4. Liquidity and the bid-ask spread. Now, this is a massively underrated concept. You know those brokers proudly screaming about their zero commission fees? Well, you can still lose money every single time you trade if an ETF is thinly traded. A wide gap between what buyers will pay and what sellers want acts exactly like an invisible trading fee. You want highly liquid, heavily traded ETFs where the spread is practically zero.
Finally, check number 5, holdings and concentration. You have to verify if the fund is actually diversified. This is a trap so many beginners fall right into. A fund might claim to track a broad sector, but when you look under the hood, 40% of your money might be locked up in just its top 10 companies. We have to ensure we aren't disguising severe concentration risk as diversification. Broad means broad. We're talking hundreds, if not thousands of companies. Let's move to Section 3, Safe versus Risky Funds, and see how this all builds together to help you spot the difference.
So let's contrast a safe, broad market foundation against a risky niche theme trap. A safe foundation is sturdy. It's like a solid brick wall, featuring low fees, high liquidity, massive AUM, and over 3,500 holdings. It is gloriously boring. The niche theme trap, on the other hand, that's like a shiny diamond sitting right on top of a bear trap. It tempts you with all this excitement, but it carries high fees, wide spreads, and just 30 highly concentrated holdings. As a beginner, your portfolio needs a sturdy foundation. The ultimate coach's rule here is that boring is reliable, and reliability is what actually builds wealth.
So I want you to actually put this into practice. This right here is your DIY ETF analysis table. The next time you're looking at a fund, literally take out a piece of paper, draw these columns, and fill it out yourself. Find the index, write down the exact fee, the AUM, the liquidity, and the holdings. I promise you, in under 10 minutes, you will be able to render a clear, totally unemotional verdict on whether this fund actually deserves your hard-earned money.
And as you're filling that out, it's also a great time to do a quick self-check on your own investing behavior. Are you in the green zone? Looking for broad, low-fee, low-maintenance funds? Awesome. But watch out for the yellow flags. Are you getting tempted by niche themes? Are you trying to switch your strategy every single week to beat the market? And absolutely stop at the red flags. If you don't understand the index, walk away. High fees? Walk away. If it says the words leveraged or inverse, step away immediately.
Which brings us to Section 4, your ETF quality rule. This is your psychological safeguard against all those traps.
And this brilliantly illustrates the exact personal boundary you need to set. Your rule should sound exactly like this. I only buy ETFs that track broad indexes, have low expense ratios, strong liquidity, and large AUM. I highly recommend writing a sentence exactly like this down on a sticky note and slapping it right on your monitor. When that fear of missing out kicks in or a buddy pitches you some hot new stock, this rule is going to govern your financial choices and keep you completely grounded.
Finally, Section 5, the 7-day checklist, your actionable roadmap. Let's keep your momentum going over the next week.
Here is your simple, reassuring 7-day checklist to guide you safely to making that very first small ETF purchase. Day 1. Pick a fund and run those 5 checks. Day 2, double-check the expense ratio and AUM on the official fund page. Day 3, look at the trading volume and bid-ask spread. Day 4, dig into those top 10 holdings. Day 5, confirm it is absolutely not a risky leveraged product. Day 6, make your final pass-or-fail verdict. And Day 7, schedule your first actual purchase. Just pace yourself, take it day by day, and let logic totally drive the process.
So, the crucial point comes down to this core question. Look at your portfolio. Does it resemble a sturdy bridge designed to reliably hold weight for decades? Or are you buying a customized sports car that's frankly destined to catch fire? Remember, beginners do not need perfect ETFs. You just need structurally reliable ones. Stick to your 5 checks, rely on the data over the marketing hype, and you will be well on your way to real long-term wealth. Thanks for hanging out with me for this explainer, and happy, boring investing.